Hello and welcome to Livewire Markets. My name is Chris Conway. Joining me today is Alec Cutler from Orbis Investment Management. Alec is a true contrarian and always has an interesting take on markets. Alec, it's great to see you again. Thanks for joining me.
Nice to see you.
Alec, a lot has happened since we last had a chat. What are the big things that are keeping you focused at the moment? What are you paying attention to?
Yeah, I guess you only needed a week to be able to say that. We had quite a while, so there's a lot of stuff that has happened. Just from a market standpoint, um, it's our gut that we're kind of rolling into a rotating market, which is a wonderful place to be as a contrarian or a value investor. So maybe there's some hopium in there that we're smoking, but it does appear that the market's a fairer place for investors, and you're getting shots on goal, more shots on goal than you would have from, say, the end of the global financial crisis through a year or so ago, where it was just a one-way freight train of a narrowing market. So it's a more fun time to invest, and the hope would be that we're going to be in a long period like that, which is kind of synonymous with a value cycle where you get you know industries and sectors and companies rolling in and out of favor.
So, like, just to pull on a thread there, so is that fairer or more level playing field a product of the fact that because the market has been so concentrated, money is finally starting to flow down? Or is it more the fact that, at the other end of the spectrum, companies that you look at, the contrarian companies, as we discussed before, or the contrarian bets, I should say, are starting to just look so compelling that you can't ignore them, or a combination of both, really?
I think it is a combination of both, and I think valuation has a lot to do with it, or it should anyway. Although once a valuation is irrational, it can get way more irrational. But I think it's that old adage that trees can't grow to the sky. When you're talking about, it used to be, hey, when you're talking about a market cap of $1 trillion, it's really difficult to grow from there. Now I guess we have to say $4 or $5 trillion.
Right.
But at some point, to justify another $1 trillion, the total addressable market that you need to consume is in the terms of an entire industry.
Yeah.
So it's those mega cap names that are driving the benchmark that are just, I don't want to say running out of gas, but just running out of headroom.
Yeah.
And at the same time, you still are having a tremendous amount of stimulus being put into the economy. And perhaps it's just a matter of really two things. One, stimulus getting spread further, and two, those industries the Mag 7, the largest companies in the world that need to have that hyper growth in terms of size, they need to stimulate the economy as well. So in order for Microsoft to double from here, they're talking about investing $500 billion. And that $500 billion goes into what? Semiconductors and factory buildings and roads to the factories and electricity generation, electricity transmission, all kinds of massive capex, which is what governments used to spend stimulus on to get the economy jump started. So maybe we're just seeing a broadening out by hook or by crook into the broader economy.
Alec, last time we spoke, you gave me a really nice synopsis of some of the major influences in your career. You talked to me about, you learned conviction from Tony, who was a previous mentor of yours, but then you learned from Alan not to hold that conviction so strongly. In the current environment where, yes, things have been extreme, what voices are ringing in your head and what messages are they telling you?
Well, if I tell you I'm hearing voices, are you going to report me?
No, not those sorts of voices.
I think, what I think is important right now, and what I've kind of collected through my history is finding creative voices,
Right.
finding people who think differently and look around corners and try to predict the future, not by extrapolating, which is what you get if you use a ton of AI. You just get answers back that everyone's getting, and you get you get a massive very efficient echo chamber. But people who really resist that kind of conventional thinking or amplifying thinking, and apply a contrarian mindset or a what's really important here mindset um, in looking at the world as it is today.
So, Alec, just to follow up there, a philosophical question, because this is something we face on our side of the desk as well. There's a lot of AI slop. I'm sure you've heard that term being pushed out onto the internet. And the more that it gets pushed out, the more that it gets scraped back and fed back into the machine, and more slop gets created. So, just like I said, a bit of a philosophical question, but do you think this is going to be critical for investing moving forward? Is the ability to think different and to depart from the narrative that everyone else has and everyone's pointing in that direction? So yeah, there could be this rise in value and contrarian again.
Absolutely. If you boil AI down, what you get is a very quick consensus answer.
Yeah.
It'll take all the facts that are there today, and it'll give you a consensus answer. But it's not looking around the wall, or it's not able to, from my personal assessment, AI has a very difficult time discerning true importance of something.
Right.
So if you ask AI what's important right now, especially maybe 6, 8 months ago, if you asked AI what's important, it would put self-esteem on par with energy security, because that's what it's getting from Reddit.
Yeah.
It's getting just as many mentions of self-esteem and popularity as the importance of energy, the price of energy, the affordability of energy, the abundance of energy. And it'll say, okay, those two things are equal. But if you look at that just from a factual standpoint, or let me think about what's really important in the world or life or humanity, no, those are not equal.
Yeah. Yeah. Energy goes away, the civilization goes away. So yeah.
Well, you can't eat popularity.
Yeah. That's a good point. I think you just sort of answered it there for me, but take me a little bit deeper, Alec. What's easier or more conducive to the way that you think about the world, when there is consensus in markets or when there's no consensus, or somewhere on that continuum?
It's the easiest question you've ever asked me. It's consensus.
Right.
I mean, as contrarians, we're trying to buy things that are where consensus says they're terrible.
Mm-hmm.
We can measure that in terms of expectations, in terms of valuation, and it's selling things or not owning things that the consensus say are no-brainer, the most important things, the best companies ever. We're not going to own those.
Yeah.
So it's in between, where there's a mix, where there's no clear consensus, that sometimes we're very comfortable. So when we buy something that's incredibly cheap, when I mention it to investors at a cocktail party, they turn around right away and walk away, because there's no way that that's a sane thing to invest in. And then when it starts to work, there's this very short period of time, unfortunately too short, where it's still very inexpensive, low valuation, but it's working, and a contrarian can feel comfortable. Yeah. And then it graduates into consensus longs. This is a great company. It's a great industry. So if you think about, the defense industry, we were buying at 4 or 5 times earnings when ESG was the rage. And I would mention that we're buying European defense contractors, and people would say that's ridiculous. Those companies have no future. And then we went through a period of time where the socially responsible funds were trying to figure out whether they were actually things that they should own, because as we used to say back then, you can't have ESG without D, because the guys on the other, your enemies, don't care about your ESG. They don't care about your feelings or your self-esteem. Yep. And and then we graduated, and that was a period of time where you felt comfortable with those holdings, to then everyone owns it. It's what people are talking about on CNBC or Bloomberg television, and we start to feel very uncomfortable again. And you can see that, buying at very low valuations, watching those valuations increase, and then valuations getting to fair value, us getting antsy, and then valuations starting to sell at a premium, and all the sell side analysts saying that premium is justified. And in fact, I think higher premium is justified, then we're getting out. That's consensus buying for us, and then consensus selling at the end, and somewhere in the middle we feel okay.
All right, let's take that a little bit deeper. Alec, talk to me about a couple of companies that you like right now that are, fitting the mold for you.
I think I'll highlight some idiosyncratic names because some of the themes that we would have talked about in the past have worked really well, and we've been and the markets continue to be quite expensive. So we're really focused on finding opportunities where it doesn't matter what the economy is going to do. It doesn't matter whether the market goes up and down. These things have drivers that are completely disconnected from any of the typical things that drive cyclicals or interest rates or currencies. So one would be a Swiss company called Berry.
Mm-hmm.
They are the largest manufacturer of chocolate in the world, of all things.
Yeah.
And the stock went down by more than 50% when the price of cocoa went up sixfold. You had a very bad crop on the Ivory Coast and in Africa, and the cocoa bean crop was a disaster for 3 years in a row. That drove the price of cocoa beans through the roof, which for a company that's buying cocoa beans and selling chocolate is not a great setup. Yeah. Even though they're kind of a pass-through tolling operation, the amount of money that they have to put out for inventory or hedging kind of skyrockets, and their balance sheet gets out of whack, and that drove the stock down. So their interest costs go up, and the stock was driven down. What we noticed in looking at that as an opportunity that popped just running screens was that Brazil and South and Central America, when they saw this happening in Africa, they started planting cocoa plants. So, I mean, you know what happens in ag when you have an observation that says the price is high, you plant more, and then at maturation, the price gets hammered because the supply starts hitting the market and you get an oversupply situation. Yeah. So there's an example of a company that is effectively us shorting cocoa. Right. The price of cocoa, because we're making an observation about a normal cyclical type ag behavior. But the important thing from a portfolio standpoint is that's occurring outside of anything else. So it doesn't matter what the PE of the S&P 500 or where we are in the economic cycle or how much debt the United States has or whether the dollar is strong or weak. It's just purely going on a cocoa cycle.
And chocolate's fairly inelastic, I would have thought. Despite the six-fold increase, you're still going to get plenty of people that will have their little treats, won't they?
Historically, it's been very inelastic. It is, when people get depressed, they want more chocolate. Yeah. So in a bear market, people will have more. Money managers like me will eat more chocolate.
Milk or dark chocolate, Alec? What's your poison?
I'm a milk chocolate guy. I totally don't get the dark chocolate thing. I've tried it. Everyone says it's healthier, and it tastes like crap to me. So
I'm a dark chocolate guy. So we'll sit on opposite sides of the fence on that one.
You'll have to explain the fascination for me.
Look, it's definitely an acquired taste. I think I just have a tendency towards things that are a little bit more bitter. So it's nothing more elaborate than that. So don't get me wrong, I do enjoy milk chocolate as well. But I would choose dark as a preference.
You consume more chocolate than I do if you're having the pure stuff. So keep doing it.
Any other names that you like at the moment, Alec?
I'll give you another idiosyncratic, but you are asking me, what my favorite child is. So it's really not fair, but
Sure.
I'm going to highlight the idiosyncratics now. Yeah. Burford. I don't know if you've ever heard of Burford. I'm sure you've heard of litigation finance, and
yes.
That's an area that goes in and out of favor. But Burford is the kind of grandfather of litigation finance. They invented it, and they are by far the best at it. And this is them looking at plaintiffs, evaluating their cases. So a plaintiff runs out of money. It's a favorite tactic of a big corporation. If you watch any of the movies, is to, if somebody has a good case against you, you just plow more lawyers into it and run them out of money to the point where they quit. Burford noticed this and said, we should lend money to these guys. If it's a good case, we'll evaluate the case. If it's a winning case, then we'll lend money to them to continue on with the case. and we might help them with some of our expertise, give them better advice. And then we'll get a percentage of the winnings. And they've been really good at it. So what is their skill set? Their skill set is in the 100 cases that come to them a week, they might take one based on the probabilities of the plaintiff winning that case. And they'll say, okay, we'll back this one. We're not going to back these 99 others. They've been really, really good at it to the point where their internal rate of return, which is how we would analyze our returns as well, is 29%, 29% IRR. I would take that all day, every day.
That's great.
So effectively, what the decision that we made as investors is we're outsourcing 2% of the portfolio on the equity side and another 2% on the debt side to Burford. And the kicker here, the big picture kicker is people don't understand it. It is on the debt side, it is lumped in with miscellaneous finance or specialty finance. The credit is not investment grade. And we had no idea why it was considered to be non-investment grade. So we asked Moody's and S&P, and they said it's really simple. We're not allowed to rate anything in specialty finance investment grade. It's double B plus. So it's just right at the bottom of non-investment grade because they're not allowed by their rules to invest anything in specialty finance, to rate anything in specialty finance investment grade. So on the debt side, we're getting Burford debt, 3, 4, 5-year Burford debt at 6.5%, 7.5% yields. We know the company extremely well. They don't need debt. And they constantly have an assembly line, a conveyor belt of judgments that are due and are payable to them. So there's cash that's coming in all the time, but we're able to get that debt at 7% on average, which is way better than risk reward is a fantastic credit for us. On the equity side, this is a $2 billion market cap. They have a single judgment against Argentina that's $16 billion. They get 40% of that judgment. So this is a case where the Argentine government stole, like literally, the judgment says stole, half of YPF. The YPF is the largest oil company in Argentina. The state, under the prior government, decided that they didn't like that private investors own that oil company, and they took it. Literally, there's no other way to describe it. They just took it, expropriated it. And Repsol and another large company were the largest shareholders, and Repsol sued and settled. The other plaintiff sued and didn't settle. They ran out of money, which is the game plan, which is Argentina's game plan. And the judge went out and found Burford to fund the case. Right. So Burford funded the case for 40% of the winnings, fair and square. A judgment was made in Burford's plaintiff's favor 14 months ago. Argentina's appealing, and they'll try to appeal it to the Supreme Court. But this is really a delaying tactic. It's something that the state of Argentina has done many times before. One of the interesting things about this is when Milei was running, he put his hand up and said, the current government, the government before him, stole this company from investors. So here's the sitting president of Argentina who has said, we stole this asset. And the government still owns the 51% that was stolen from Burford's client. So it's not like this asset that was stolen has disappeared. It's still there. So $16 billion judgment. If Burford gets 40% of that, that's over $6 billion on a $2 billion market cap. That's got to be the definition of idiosyncratic.
Alec, I'm conscious of your time, especially considering you're with your family. So one, to finish off, thoughts as we head into 2026. Not asking for any crystal balls or any major predictions or anything, but how are you feeling about your space and the opportunities in front of you as you look to the year ahead?
Keep your seatbelt on.
Right.
It's gonna be a wild ride.
Nice note to finish on. Alec, thank you so much for being generous with your time. Very much appreciate it. Like I said, I know you're with your family celebrating Thanksgiving, I think. So yeah, again, very much appreciated. It's very kind of you.
Thank you.
If you enjoyed that interview, make sure to give it a like and don't forget to follow our YouTube channel. We're adding lots of great content every single week.